Okay, great. So we're going to record this so that anyone, we'll be able to put it out there so that more people can view it. Anyone who wasn't here today, if you think that this was super interesting and want somebody to hear what you heard, you'll be able to point them toward this. So I'd first like to thank Cyril Glockner here in the front row. Thank you for sitting in the front row, Cyril, for hosting us today.
Welcome.
And Cyril has been an investor with Seattle Angel Conference through a couple of different rounds and done angel investing. And he is here at Microsoft in Building 99. And so we're really happy to have you here today, and thank you, Cyril. I'd also like to introduce John Seacrest, who is here with me, the organizer of Seattle Angel Conference, which we'll be talking about a bit, although I will cover very broadly angel investing in all the different groups here in Seattle. But John has been running Seattle Angel Conference for 8 years. We're now in our 16th round, having produced many new angel investors, groups, funds, you name it, funding many different startups, and seeing a lot of great startup activity come through Seattle Angel Conference. So that's John. Monica will be joining me shortly. She is working with me on Seattle Angel Conference and is also an angel investor. So what I'm hoping we can do is explore a few anecdotes toward the end of some of the kinds of experiences you can get through angel investing beyond just the financial returns, which we will also talk about what that might look like and how to understand how that plays out in a portfolio type strategy. So I'm not going to trip over this. I'm going to move it. Otherwise, I will keep tripping over it. Okay. So Angel 101, this is me. I'm Minda Brusse. I have made my on-ramp into angel investing relatively recently, in the last 18 months or so. And before this, I was a serial startup operator. I was one of those consistent co-founders, people in the ecosystem, doing advising and getting things from 0 to 1 over and over again. And that's sort of my favorite place to be, which is why angel investing started to make a lot of sense as I looked at what I wanted to do next. There are people on here like Ellen Neiman and Yoko Okano and Javier Tortable who have all contributed to these slides over the years, as we have all been enthusiasts about bringing other people into the fold. So this is a presentation that I have adapted for my own use. So we'll go through a couple of things. But I first wanted to find out, sort of by show of hands, who is here because they are interested in learning about angel investing for themselves? Or okay. Anybody here who is thinking more like a founder and wants to learn how angel investors think? Awesome. You guys are probably the smartest people in the room for being here for that reason, because I think that that's actually an undervalued founder skill, to understand how angel investors are constructing their decisions and how you might be more effective in interacting and building those relationships. So, and is anyone here just because they're just outright curious? This sounded interesting, and you could use a coffee break. Okay. I can see why you wouldn't just raise your hand for that, but fair enough. Okay. So we're going to talk about why we angel invest. We're going to talk about some definitions like accredited investor and some things like that. Angel investing landscape. This is where we'll talk quite a bit about just sort of like what's out there nationally, what are we doing in the Pacific Northwest, what are some of the different groups. We'll get into the portfolio construction. So the sort of impression that I had of angel investing was that it was super high net worth individuals at the Rainier Club tossing out checks and just going, hey, good luck. And I was like, well, that's never going to be me, right? And so when I was able to get through an Angel 101 presentation like this, it started helping me identify how you can actually build a financial portfolio strategy that takes this high-risk category and turns it into something where you have a viable opportunity for return if you can kind of fit this model that seems to have been patterned out, proven through research to sort of indicate that there is potential for financial success. Of course, you can see I'm caveating every word I say there, as one would. Evaluating companies. How do you evaluate an early stage startup where every single early stage startup you see as an angel investor probably has a gaping hole of risk that would kill it in the next 6 months to a year, and you could like drive a truck through it. And that's not a reason not to invest. It's a reason where you want to sort of circle around and figure out what that risk looks like and decide if there's a path through it before the company runs out of runway. So we talk about evaluating that differently than you might look at a proposal within a corporate organization or a startup that's far more mature and that has a proven revenue model and business model. So we'll talk a little bit about evaluating companies as an angel investor. And then I would love to leave some time for questions. So I'll actually move through a lot of the slides relatively quickly. Why we angel invest. Go back to that. Financial returns, there really is a good potential for investor returns if you do things diligently, and we'll talk about that. Also the experience. I call angel investing a contact sport because you're not like physically hurting anybody or anything, but you are getting the opportunity to interact with other investors, very much to share diligence, to share deal flow, for networking, to find out what's going on. And so there is that aspect. And then there's the aspect of working with founders. So whether you're doing due diligence or learning about new ideas that they're producing, or you're actually investing and then sometimes helping by creating something through a network, introducing them to a customer, there's the opportunity to be involved in creating something from that 0 to 1 phase that can be intensely rewarding. I would say that the surface area of your professional network is something that has really unbound opportunity. One of the things I've enjoyed most is that the people I have met and gotten to know are similarly curious, like to know about new things, are energized by starting something new, and like to explore ideas. And so I've met people from the financial world, the media world, all these places that I might not have intersected with, and that's opened some really interesting doors for me that I wouldn't have been able to predict if I had just expanded from where I was at. So I would say that those are sort of the 3 categories. And then when we get into Q&A, maybe John and I and Cyril and when Monica arrives can kind of share some of those experiences. Definitions. Angel investor is an accredited investor, we'll explain that uses their own money, their savings, to invest in startups, usually in exchange for convertible debt, which means a note that has terms attached to it as if it is a loan, but that has a trigger to convert into equity, or actually just straight up buying shares in a company at a set price. A good angel investor takes time to learn how to do this successfully, so good that you're actually getting some information. There's a lot of self-education beyond what I'm presenting today. But to do it successfully and be a good angel investor, like I said, you can just be one of those ones tossing off checks, but that is not necessarily going to produce a return. It's more like speculative if you're just sort of doing it without disciplined thought or process. So let's talk about what makes an accredited investor. And this is a term that our US government uses in order to determine who's eligible to invest in startups. And you can meet any one of these 3 criteria and be an accredited investor. Usually you're self-certifying, but sometimes you will be asked to provide like a letter from an accountant. An individual who makes more than 200K or 300K with a spouse for at least 2 years, sort of a last year, this year, and likely next year. Or an individual married couple whose joint net worth exceeds $1 million, but excluding the value of their primary residence. And then a trust in your name with more than $5 million in assets. This is designed to, because this is a high-risk investment category, they don't want people to invest money they can't afford to lose. That's really the sort of guiding principle behind why these rules exist. But it's really important you be aware of them because if you're not accredited and you do invest, you can really unravel some pretty significant things for yourself, for that company. It's something you want to be very aware of and making sure that you know your status of where you are in the accredited landscape. So startup versus small business. So if I am going to start a sandwich making business on the corner in my neighborhood, it's an awesome small business. It might make me a fantastic livelihood. But a startup is a different thing. We talk about these as ones who are taking outside investment in order to achieve a liquidity event, in other words, being sold to a company or doing an IPO, of some amount of multiple of returns within about 10 to 12 years, right? So it's sort of a pretty specific category of people who are likely able to take these kinds of funds and produce a return. And the idea is that if you invest in my sandwich business, how am I ever going, I mean, maybe if we don't do that as a loan and you just own part of my business, then how am I ever going to get my capital back? Like, are you going to sell the sandwich shop someday? Is it going to be worth anything to anyone? Is it really going to appreciate in value? So when we look at startups, we really look at ones that fit that category, and that's the kind of investing that we're talking about. Okay, so then there are the VCs. VCs have accumulated money from investors and have a thesis, a strategy, a check size, a stage, and that's what they're making their investments from. Let's see. So different size deals. You can see angel fundraising is more likely to be at the smaller and earlier end of the scale. And it's more challenging as companies get into the later stages to sort of be in there with the VCs. We can talk lots about all of that and how companies move through the capital raising process. But VCs are almost always returning based on the power law, which is that a few or one company makes back the entire fund and generates the returns. So in other words, there's a lot of failure and going to zero, or just maybe even just returning the funds that were invested. So that's something to know about VCs if you're going to be an investor in a fund. It's also something to know as an angel investor. We'll talk about some of the stats around that. VCs investing in fewer later stage companies than angels traditionally do. So looking at sort of the broad landscape, there is about $21 billion invested in 64,000 companies, and you can see the concentration with venture capital. So we're not yet at the amount of venture capital that was deployed in the dot-com boom, which was about $100 million in the year 2000. We're still below that, but you can see the concentration. It's getting more concentrated. And in fact, there was recently a book written by a guy named Scott Kapoor, who is a partner at Andreessen Horowitz, talking about how much later companies are waiting to go public and how much more wealth accumulation you can have in the private markets now than the public markets. So it's really maybe feels unfair to the general public who would traditionally have bought Microsoft when it went public or in the last few years and gotten that 1000x return. Almost to the point of what a VC could have made. And now those opportunities are less so, with Facebook only trading at about 4x of where it went public. So there is a shift in where the capital is circulating and where wealth accumulation in terms of equity is taking place. So it's another reason to consider sort of looking at your portfolio strategy for where you invest, how you invest. All right, so this isn't updated with the latest, but it gives you a good sense of that the Pacific Northwest up here is about 7.1% of where angel-backed deals are located. You can see the valley is really heavy. You can see that they took a big swath of the south there that are 12%. So you can see that we're not dominant, but I believe that we have some fantastic opportunities in this area, and it's probably there is more opportunity than investors are currently participating, which is why so many of us are like wanting to encourage others to join in all the great companies that you can help grow from here. So we expect to see that number grow. And John, is it growing? I think we saw a more recent number.
It's actually been, as a total volume, it's been relatively constant.
Yeah.
But what has happened is New York and Boston have picked up, and so our percentage has gone down as a percentage of the total number of deals.
Right.
But we tend to be sort of constant dollars.
Yeah.
There's a slide that Mike Pritchard put together that is that slide with per capita numbers.
That's the newer one.
Yeah, and that shows that we're like number 4 in the country in terms of per capita investment.
Right. Again, talking about the distribution of returns being really something that you have to be prepared for. Some people might say you have to have a stomach of steel. And if you look at why startups are failing or how they fail, what happens, I'll bring your attention down to The Walking Dead. That's where maybe I invested $500,000 over a couple of rounds. That company is going well, is surviving, maybe producing a modest profit, but is never going to be a great acquisition for a larger company. So there's no way for me to get my capital back unless they repay it as some sort of revenue redemption or something that we negotiate much later. I mean, that's not something that you want to have in your portfolio, but it is something that can happen. And you can see down here also how few companies are IPO. And that percentage might even be high. Why would anyone do this with all these failures of companies in your portfolio and the hope of returns on a few? Because angel investments are uncorrelated with other asset classes. Yes?
Sorry, just trying to understand the data which you presented in the previous slide. So are you saying that 0.1% of the companies actually go for an IPO?
0.1%
Of angel-funded
of
companies.
angel-funded companies going public with an IPO. And I believe that's probably going down. Mergers and acquisitions are by far the most common exit and are very, and can happen at different levels. It can happen at the acqui-hire type level, where it's a modest exit, maybe a 1x or 1.5x return for the investors, or a 0.5. And sometimes it can be, a $600 million acquisition, and everyone can do very, very well. So it's not to say that an IPO is the only way for you to get a liquidity event. Really, M&A is where it's at. All right, so this one's a little hard to see, but it talks about the distribution of returns in terms of you're going to see a lot that are 1x return on your money or less. In other words, you're getting maybe your money back or less than that. You can see the 1 to 5x here, 5 to 10x your money there, and then all the way up there, there's those big 30x returns. So you can see, again, this power law is really at play. And also, you can see how it happens over time, that you fail early and you get your big returns later. And so that can also be something that causes a lot of concern as you watch your portfolio, is that in the beginning, you're making investments and you're watching, the ones that fail are failing early, and then the ones that are returning further out. So your return, and this is a relatively illiquid type of investment opportunity. But why would you want to do this? Again, I go back to, there are financial returns, and I'll talk a little bit about a model that you can kind of calculate in your head, but it is interesting companies, interesting ideas, interesting people. For those of you who like to explore what currently is going on, I got to learn about drones and go to a lab and watch one fly around on a self-designed path and snap pictures of all kinds of heat sensors, and it was very interesting. I really got to learn about the market for it as well as I was evaluating, is this something that's needed? How big is this market? And does this company have that chance? It was a really great opportunity to get to know other investors as we were exploring that together too. And then you can make a difference in somebody's company. I'm going to be working with someone I actually advise. I'm going to be wearing a t-shirt. I'm going to be standing in front of Amazon. I'm going to be handing out discount cards to get people into her beta for her fitness app. And I'm really excited about it. We're going down there with her technical co-founder and some other friends. And it's just one of those opportunities that you just don't get when you're not involved with that sort of 0 to 1, where you're doing these wildly unscalable things and trying new things and failing or succeeding and then trying to figure out how to recreate it. There's a lot of energy and joy in that, at least there is for me. Okay, building your portfolio. So this is where we get into, I think, for me, the most helpful math, which is owning, you really want to spread your risk out across many companies. 20 if possible, 20 different investment opportunities. So some you may have 10K in, some you may have 50K in, but that diversity in numbers is essential, is what the research shows. And then in terms of the portion of your net worth, it really is your risk tolerance and your understanding of how those returns are shaped, to understand that if you look at typical guidelines being 5 to 10% of your assets, again, excluding your primary residence, and that you can look at that also as maybe 10% of your free cash flow. So that's where you have to decide for yourself, but modeling it on this, you can strive for an internal rate of return of about 25%. So that's a model that has been borne out through research, but is not a guarantee. And so how do you do it right? Here's the diversification. It shows you the more you have in your portfolio, the better your odds are. Here's some portfolio numbers where you can see all the company A goes to 0, 0, 0, 0. And then, look, company J returned 24x. So these are different models of returns, and you can get really into Excel and playing around and modeling portfolios and doing all kinds of stuff to get familiar and acquainted with what those numbers might look like and feel out your own risk tolerance a little bit. Let's see. Okay, so let's talk about investing in terms of how you spread it out and make that 20 company number happen. An individual investment in a startup, typically the minimum check size is $25,000. So if you multiply that by 20, that's actually a pretty big number. However, if you invest through groups or syndicates, you might be able to write smaller checks like $5,000, $10,000. And that requires being part of a group, investing with other people, and that's where I talk about angel investing being a contact sport. A lot of that happens through relationships and networking and finding those opportunities. And so they're out there, but you should be aware that if you're just going to be sort of the lone wolf out there writing individual checks, that the expectation from startups is that a minimum check size is 25. Sometimes it's 50, sometimes it's 100. It depends on the opportunity. Developing your own goals and guidelines is essential. I've given you some models today, but as I emphasize, self-education is super important. Learning how to invest as part of a group has been one of the most rewarding things for me because we're sharing points of view, we're sharing deals. I'm learning about new things that are happening in other parts of the West Coast. And you can see down here how 10 people coming together can make a 50K check happen. And that happens through a special purpose vehicle if you all come together to decide on one opportunity. You can also invest in small micro VC funds, which probably have varying degrees of the amount of participation you can have and might be more passive, but might be a diversification strategy as well. Invest in what you know. This is like a really important thing. And it's not to say that you can only invest in something that you are actively working on right now. But I, for example, would not feel comfortable investing in, like a drug discovery company. I just don't know enough about that life sciences landscape to feel like I can make a good decision. And so that's not an area so it's kind of like you really should be careful what you look at because you just don't know what you don't know sometimes. But I'm really interested in blockchain and I have some experience there. I have a strong network there. I have a good sense for what's going on in that space. And I have an area of that ecosystem that I do feel has investable potential right now. So investing in what you know and your relationship to industry expertise is really important. And remember, you can also lean on other people that you come to trust through those angel groups and investing. But again, investing in what you know is essential. Spending time on due diligence. So due diligence is like when I talked about like driving a truck through the risk, that's due diligence. It's saying, I've heard the story from the startup, now I'm considering investing, now I have to look under the covers and see, does the story that they told about how they're going to do this, the market size, do I find that story credible? Can I independently verify the market size? Can I interview one of their customers? Can I do a site visit? These things are not always available to every angel investor on every opportunity. Sometimes the decision process is quicker. But they're all really good, important parts of developing your independent verification that this deal is in fact what you think it is, and that the risk is in fact what you think it is. And sometimes, honestly, startups don't know where all the risks are, and sometimes you may actually find things they didn't. So you shouldn't rely just on them to provide you with the due diligence. You really need to do your own exploration and inquiry on that. And that can be a really fun process, actually. You can see the literal impact in your portfolio when you spend time on due diligence. The numbers bear it out. Angel investing options. So this is a little bit about the landscape here. And this is a good one to get a snapshot of if you want to know a little bit about what's going on in Seattle. So you can be the lone wolf investor, writing those individual checks, really making your own decisions. And there are some really successful ones out there in our ecosystem. There are active angel groups where you invest maybe $50,000 at the beginning of the year. You might participate on a screening committee, you get involved with the companies, but you're not responsible for finding the deals, or even you're maybe part of a team that evaluates them and makes decisions for the group, and then the group votes and decides. There are passive angel funds like AOA's Alliance of Angels, which has been around here in the ecosystem for a very long time. And E8 is a clean tech fund. I think it's Element 8.
No, it's straight E8
Or is it straight
now.
E8 now? Okay.
They got sued over the name.
And then there are managed funds. Like I mentioned, you can be a limited partner in a fund like Founders Co-op, and then they do the professional investing on your behalf, and maybe they'll call upon you as an investor to help with a door open or something like that, but you're really turning your money over to them to produce the returns and make the decisions. Yeah.
One question. So how are the event funds and active angel investing groups, how are they fundamentally different from VCs?
Yeah, because individual investors are pooling their money, and there are different models for decision making, but the decision made by the group versus a professional fund manager making the decisions is really one of the fundamental ways you see the difference there.
And importantly, VCs are investing other people's money, where angels are investing their money.
Right.
And strangely enough, investing other people's money hurts less when you lose it.
So I want to talk a little bit here about Seattle Angel Conference, which is, for me, has been a really effective on-ramp into angel investing, because it taught me how to evaluate investments, it taught me how to do due diligence, and it continues to teach me the relationship building and the network building that I need to be really successful. So at Seattle Angel Conference takes place with a bunch of workshops leading up to what I call the game on time, which game on is about to happen for round 16, which is where we get up to 40 investors together who all put in $5,500, which is, you can see, not a huge amount when I talk about a usual check being $25,000. The idea of pooling those funds and getting that group together is that over 10 weeks, we're going to see a large group of startups that are now applying. By the way, deadline August 29th for this round. Those startups apply, the investors come together, and then over the course of 10 weeks, we go through a slowed down process of angel investing as a group. So there are benefits to slowing down. One is that it takes it on a week-by-week basis and really helps us first identify, how do you evaluate a pitch deck and decide, do I even want to learn more? That's fundamental. Do I even want to learn more? Not do the full due diligence, but just, do I even want to know more? How effective can you get at seeing all these pitch decks and being able to sort of pull in the ones that are really interesting? And hearing from the group and who is finding those interesting is a good way to sort of get more ideas and balance on how other people are doing that. So you're learning from the group. The group is usually about half experienced angel investors and half newer investors. So you get that mix as well. So the conversations are really facilitated and very interesting. As we go through and winnow it down from 24, we hear from, we do 3-minute pitches from all the companies with 3-minute Q&As, and then we knock it down to 12, and we get 10-minute pitches with 10-minute Q&As, and then we winnow it down, and by week 6, we're picking 6 finalists. Those 6 finalists are the ones that we will form due diligence teams around and go through a 4-week due diligence process. Usually you will not yet again, unless you go through Seattle Angel Conference again, get the, I think, rigor. Maybe you will in other groups, I'm not going to say. But we do a good rigor of learning about due diligence as we're doing due diligence. It's a little bit meta. But I find it really effective, and I learned a lot by producing a report with a group of people who all brought different questions and ideas together, and we worked really closely with the founder and the company to explore all those areas I was talking about in a really disciplined way. That my goal is always to use the founder's time well. Be effective, be efficient, because as an investor, that's the kind of relationship you always want to be building with your co-investors and with startups. And startups, one of the most valuable resources is time. And you don't want to take that away from them unnecessarily. So Seattle Angel Conference, like I said, is starting up. We're actually meeting in this room pretty much every Tuesday night starting, well, next week. we have our investor social kickoff. Everyone gets to kind of get to know each other and start that process. Because by the end, when we do those 6 finalists, we take them to a general event, which will also be in this room on November 13th. They get to present, and they get to share what their company is, and sometimes that's changed a lot over the course of 10 weeks. Sometimes due diligence questions even shape things. It's fascinating because they're so early stage. Then, as a group, during that event, the investors get together and we take a vote. Which one do we want to take our pooled funds, which are, maybe $150,000, $200,000? Which of the 6 finalists do we do that with? I, as the fund manager, actually do the negotiation to make sure we can come to good financial terms with the companies we choose. And the due diligence process has let us know if our group thinks that if that due diligence group finds this an investable company. So we have those decisions to weigh, and we make that on the spot, and we do the big check moment. Is our question in the back?
Oh, no, sorry.
Okay,
No.
cool. And then we can talk about some other sort of models for accelerators like Techstars, Pioneer Square Labs, Madrona Venture Labs that have a different way of spinning up companies, producing that original investment, and accelerating them through to viability. So here's some info on I call it SAC 16, Sweet 16. I would love to do some sort of bracket system for the companies that go through. We'll be here, pretty much in this room. Pitches and Q&A from 24 companies, narrowed down to 6 finalists. I'm summarizing what I just said. Due diligence teams to form and evaluate the finalists. Those final 4 weeks of producing that report, doing customer visits, site visits, you're really stepping through something that when you're out in the wild as an angel investor is probably going to be far more accelerated. But it's so good to have gone through doing that discipline. And the final presentation, the general audience event, is something that anyone can buy a ticket to. So we get investors, we get students, we get other startup founders, we get people who were early on in the process, who bought their ticket when they applied, coming and seeing, well, how did this all end up? It's more than a winner-takes-all opportunity. I have to say this is just abundantly clear and true. We get startups that come through over and over again because they get coaching, they get relationships. They are benefiting even if they never get that final check. They meet angel investors who become advisors, become investors, become champions for them in the community. And I just think that it's just a super opportunity for interacting and seeing really an ecosystem in a small, knit together way. The other thing that happens is we will decide at the end, close to the end, whether the investors want to get together and do a sidecar fund. So when we pool our money together and we make the decision, we've already set those funds aside. But let's say we find 2, 3, or 4 of those finalists very compelling, and we've done the due diligence. The investors are all interested, perhaps, and maybe we'll form a fund, and then that fund can be even bigger or whatever amount we choose for it to be. It's not limited to that $5,000 per person. Sometimes we've had sidecar funds bigger than the ultimate prize. So again, not a winner-takes-all sort of event, even though we do narrow it down and try and choose one winner. Talking about evaluating companies and why startups fail, it's really important to know that there's some majority of the time, 42%, no market need. I was just down in the Bay Area at Y Combinator, and the fortune cookies all said, build something people want. Because it needs to be repeated over and over again in our ecosystem, how important it is that the idea that you have and are passionate about actually has a market for it. So you see a lot of failure at that level. Ran out of cash because maybe you didn't plan ahead properly, maybe you just couldn't get the funding in time, you didn't time when you were fundraising properly. That can happen. Not the right team. You can see co-founder issues, you can see geographic issues, you can see lots of reasons why teams pull apart at these earliest stages when things are so challenging. And sometimes it's just not the right team for that problem. And that's another thing angel investors have to suss out is this may be a fantastic opportunity and a great problem to solve, but if the person has not got the right expertise or the ability to build a team around themselves, that's unlikely that they'll succeed in solving that problem. So that can also be a really key area here. So you can see poor marketing is actually pretty far down the list. And failure to pivot down there, burnout, legal challenges. I mean, companies can get killed 1,000 different ways. All right, so companies succeed with market timing, right? right solution for the right problem at the right time. And I can't emphasize this enough. There's a company that I just saw recently that's a startup that I tried to do 10 years ago. And they may succeed because digital media has changed. And so maybe it was a market timing issue, maybe it was a Minda issue. We don't know yet. We'll find out. Team, the essential ingredient that we're always looking at the earliest stage that is more knowable is who is this team? And can they expand the great parts of this team, and can they build that out? Can they tackle this problem? Do I have confidence that they can actually find a way through this path, which the path is never what you think it's going to be, so you have to believe that the team can be flexible and nimble enough to work their way through to some success. Business model, and then obviously like getting funding. So when we talk about what makes a great company, here again, market opportunity, is there a really big dollar amount attached that this pain point represents? Billions of dollars is a great number. If you're getting into billions, you're great. If you're looking at a $5 million problem, it's really hard to say you're going to be able to make a huge splash of a company out of that, again, a startup, not a just regular small business. So the market opportunity and then the product and solution. Oftentimes, it's so interesting, you fall in love with how you think the problem should be solved instead of falling in love with the problem as a founder. Trust me, happens all the time. Evidence of traction. If you just can't get those customers, and oh my gosh, it's so hard. One of my startups, we had to go knock on office doors to sell our solution, and it was really painful. Sandeep had worked at Amazon and Microsoft in engineering, and knocking on and cold calling on offices to sell our solution was not at all comfortable or something that we were just like, yeah, this is going to be effective, but we did it, and it was painful. And we were told we actually were told, like, you're soliciting, we don't allow soliciting, and we had to like leave places. But that day, we also got 3 customers that are still customers. So it is sometimes really hard to get that traction. A lot of times, it's easier to sit behind your computer than it is to actually go out and talk to customers. So getting out of the building is huge. Summary. Good angels, again, IRR being possible, small percent accounting for success, so you have to be prepared for the large percent not being a success. And successful investments will have high multiples. You talk about like a 10x return. And more due diligence in investing in areas, if those are success criteria that you should really pay attention to. And then finally, the Pacific Northwest being an excellent place to invest. We have seen so many great entrepreneurs come out of companies like Microsoft, Amazon, UW. We have a really fertile ecosystem for teams to form, and there's a lot happening. And being part of the angel investing community here in Seattle really gives you a close-up opportunity to see what that is and what that's like. And you don't have to give up your day job to do it, but you get to be a part of this really interesting, fun ecosystem that happens around here in Seattle. Okay, so again, look at the big red things. Grain of salt. Please do not just take these numbers as a given. Self-education's paramount, and you can see how if you just write 2, 3 checks, that just really is not a recipe for success. That's hoping for a miracle, hoping for massively good luck and timing. Okay, resources. Another good one to take a snapshot of. The David Rose book is always at the top of everyone's recommendation list, but especially John Seacrest's. There are others out there, and I like reading from a whole point of view. I'm kind of a go-wide person. And so you can see some other things on here. The Angel Capital Association has a lot of educational resources. And that's a national organization with regional chapters. And so you can just see here, this is just the start. There are so many articles, research, things to follow. I am a learn by doing person. That's why Seattle Angel Conference has been so much better for me than a book. But books have their place as well. Okay, so this is sort of my calling card for today. And I'd also like to take the opportunity to introduce Monica, who arrived in the back of the room. Monica is reachable here, I'm reachable here, this is John. So the three of us are really the core team for Seattle Angel Conference 16, which, like I said, kicks off September 3rd officially, but we're having a nice little investor party that should be really fun next Tuesday. And you don't have to have already committed, you just have to be like, I'm pretty interested in this, to come and join us and learn a little more, meet some of the other investors. But again, we're getting together that 30-40 group of investors, hopefully a total of 40, and hopefully 50% women. You notice there are fewer women in this room than men. That is typically true in angel investing, and I think everyone wants that to change, not just the women. And so when you see the three of us, we each play different roles. John is our facilitator. He has been through this so many times. He really knows how to guide us through this slowed down looking process of making a group investment. Myself, this is a volunteer opportunity for me to be the fund manager. I'm the one who is getting the investors together, having everyone, creating the LLC vehicle, getting the funds into the vehicle, and then ultimately negotiating the financial terms to make the investment. So it's a real fiduciary responsibility, I feel, on behalf of the investors. Even though they're making the decision, I'm the one ultimately making the investment, wiring the funds, and then over the life of that company and this fund, probably it's like a 10-year, it's like the longest volunteer commitment I've ever made, 10 years probably. Hopefully following them through to an exit and a return for the investors. So Monica is my assistant, which means that she is incredibly helpful to me. She probably passed around a sign-in sheet so that we get to know who was here today and be able to follow up with you. Monica is also really sort of shadowing me as I shadowed our last fund manager, and she will be in charge of Seattle Angel Conference 17, which will take place on the Seattle side. We flip back and forth. And then feel free to contact any of us with any questions, because we've just been immersed in this and have, just been trying to bring more people in and answer more questions, whether it's about Seattle Angel Conference, Alliance of Angels, Sea Change Fund, any of those things. We're just enthusiasts about angel investing and giving people a really good foundation and a start to it. So with that, I will turn it over for questions.
Thank you.
All right, yes.
Tactically, when you assess a team, what do you probe for?
And this is just going to be a Minda answer. One of the things I look at is emotional intelligence, because what they're going to have to do is sit in the middle, the leadership team, in the middle of an investor group and a team that they're building. And they have to build both sides of that equation effectively over time. And so it's not necessarily about their technical know-how, it's about their ability to build an organization know-how and be able to construct those relationships and maintain them over rocky waters. So that's something that I really look at. And I want to see someone, also a team that has experience working together. I love to hear when startups come in and they say, well, we've been working on this problem and we're doing some work with early customers and it wasn't working, and so we pivoted, and now we're doing, and I love hearing that, because it means that they've gone through what feels like failure, they've stuck together, they listened to customers, and they made a change, right? So those are just signals I look at, but there's never enough data. And so that's why going over and over again and meeting with so many different teams starts to give you a better and better way to read those cues that are important to you. I don't know, John, Monica, anything to add on team? How you look at team?
So one of the things that's important is to realize that there's a set of skills that are needed. We start typically with who's the one that gets customers to the door and who builds the thing that you're selling. But somebody has to do financial modeling. Somebody has to build the culture of the company. And as you go from this group of 3 or 4 people to this group of 40 to 50 people to this group of 300 people, how I personally respond to that over time necessarily must change. And so the ability of that group to understand their role and then evolve into the next role is something that you look for.
Mm-hmm.
And you might ask the question, why do we do pitches? Why do people have to stand up in front and talk? And part of that is we're looking for the ability for them to work as a group. And you can watch the CEO speak and the team members in the room communicate non-verbally. And when that happens, things start clicking. And we've watched teams work a room with intent, and we've watched other teams with the CEO that's the commander, and all of the engineers are sitting on the edge with their hands in their pockets, and that is not a team, right?
So you
need to
look
get that
for
intuitive.
balance in contribution. You look for all those things. And so it's always about subtle signals. And that goes for customer validation. That goes for all sorts of things in these early stage startups, because you'll never have the kind of data you have at scale. Yeah.
Are the decisions to invest in a particular company based on a consensus, or can you be like the lone dissenter, but you're still obligated to?
Yep. That's the idea of a fund, is that we all commit up front, and then we go through the process, and then the majority vote is where all the funds go. And so occasionally we've picked 2 companies and then made sure there's a big enough pot to divide and do 2. But you get a chance during the 4 weeks of due diligence to really express your opinion, championing or raising risks and questions.
If you see some big red flags, you're still compelled.
Yeah.
And so we do try to aim for a supermajority, so
Yeah.
it's not a, 50.1 and a 49.9 kind of vote. We would like the majority of people to be comfortable with where they're at, with some level of margin in that. And so it is, money comes up front and the group makes the decision. There's no obligation to not invest in other things if you want to. And so if there are other companies that show up that strike you as interesting, that nobody else in the room thinks about as being interesting, we've had that happen. The software engineer that is totally thrilled with hydroponic lettuce.
Yep.
that
And again,
company's-
it's a $5,000 investment, and some people think of it as really sort of just a training fee, because it's a relatively nominal investment as far as angel investments go, and even if the return is many, many multiples, you can see how $5,000 isn't that. Okay, yes, right there.
Hi, so can you talk about a time when you were really excited about an idea at first, and then you kind of realized some concerns, and what questions you asked to make those concerns come out?
Yes. I'll go back to the drone company, because I was really interested in the fact that they had these drones that could work in industrial settings. And then visiting the actual workshop that they were building these drones in, I got to see how kind of fragile they were and how they were a little bit more imperfect than I expected. And how the pilot customers were big, huge conglomerates, but really, in reality, it sounded more like maybe they were just piloting this to kind of just see what was out there and do some R&D on the cheap. And maybe they weren't really going to extend it all the way into that organization. So those sorts of doubts started to come up, and then we started to see the CEO sort of like lose some energy. And in the process, just started to see some things that made us feel like, especially me, like asking the questions that were about customers, about market, about seeing things with a primary research focus is really sort of what changed my perspective. I don't know, Monica, John, have you ever found that there are some key questions that you've asked that have kind of led you to lose your excitement? Yeah.
Go ahead.
One thing I would just add is that time, take your time, because there's been companies I've been enthused about, and I think, well, if I'm excited about them today, they should technically still be around 3 months from now. So let's see how they make progress, because I'm just not quite sure. And then 3 months from now, not seeing the type of progress I would expect, like, I'm glad I paused. I'm glad I just didn't rush to write a check in my moment of enthusiasm. So I think passing of time is also important.
Yes.
As I said, several things. The passage of time also will expose weaknesses in the team if there are
Oh,
any.
yeah.
Anybody can be good for one meeting.
Right.
Um,
Yes.
I had a startup in the 90s, and when I was in the kissing frog stage trying to raise money, I was offended. Everybody was asking me if I paid my taxes. Of course I pay my taxes, right? Then I got to the roll-up phase, and I was doing diligence on potential merger partners, and every one of them had a tax skeleton in their closet.
That's another thing, looking at the cap table and finding out that all the founders have already vested all of their ownership, and then realizing that if I made the investment and the key engineer that I'm really counting on leaves, not only do we lose that person, but that equity can't be redistributed. So those kinds of things are also things you can uncover during due diligence. Yes?
So what are the metrics that go into whether an investor wants a company to either IPO or just get acquired by a larger company?
Right. So that's a much later stage. And that really comes down to board and board governance. When companies are selling equity, which is usually, like I said, we do a convertible note or sometimes equity, angel investors are rarely involved at those later stages in the governance of the company and those decisions being made. But how those decisions happen, a lot of times the alignment of what company you're building is really fundamental and begins at the beginning. And if the CEO is smart, they get a group of investors all the way through that are aligned with where they all want the company to go. As later stage investors come in, they get more governance. So you find that VC firms, when they come in on like the Series B, Series C round, really exert the majority of control over the company and will negotiate for strong governance rights. So I would say that it really happens at the board level, and you want to make sure that the CEO that's starting has the ability to be an effective CEO. Again, we talk about managing the investor group, managing the company. They also have to have a really good relationship with their board in order to retain control and in order to be able to negotiate for governance that gives them continued control. So I think that's really where I see it. I don't know if you guys have a different.
So 80% of companies get acquired before 50 million in valuation. And so if you start building a company that's 200 million in valuation, the probability of you getting acquired keeps going down. And so if you have a vision for a market that's billions and billions of dollars and you get a nice corner of that market and you're a $500 million company, you're well on the way to being an IPO. And if you are not aware of that at the beginning, you won't have put the foundations in place to make that go well. And so really at the very beginning, when we're asking what's the total addressable market that you're aiming for and how are you going to do that, we're essentially asking the question, are you going to do an IPO? Because that will determine a bunch of that foundational stuff. And if they're trying to build one kind of company and they're hiring a different kind of person or they're building a different kind of market, they're crossing over in a way that they're not actually going to sustain this business.
Yeah, and these things also change over time. What kind of company you're building, you may expand the market by virtue of delivering a solution that actually creates a larger market than you initially started with. So many things change over time in these early stages. I think alignment is the key at the beginning, like John's saying, and building the right foundation and understanding the trajectory and that narrative, even though it may not be the exact numbers and path. It probably will not be the exact numbers and path you think. The intention really matters, I think. Yes, in the back.
So you called out as a $5,500 investment here for doing the Seattle Angel Conference, but you also say that you should be looking at diversification, sort of a minimum of 10. If you're just doing the same number across, you're talking about 55,000 to 100K that you want to be looking at in the angel area. So after this initial one, you've talked about other things, but how do you, taking the next step to looking for the next 9 opportunities and putting those together, what's the time frame that you would expect?
Right.
Forming a group, you may come out of it very happy. It's great as, okay, I've done this, I've done the thing, my ticket to learn and say it's not for me.
Right.
At 55.
Exactly. And then I'm the volunteer who manages it and gives you your K1 every year, and you're like, I've been out of this for a while. Typically, you're looking at a 10-year trajectory on any company you invest in. As you read these books and get acquainted, you'll develop your own investment thesis, your own portfolio strategy. And so there's no single answer that's a right or wrong answer to what your question really is. But it's just a matter of knowing the opportunities in the landscape that are accessible to you, and then what your total amount that you think you'll ultimately deploy in angel investing really is, and what you want to do. Some people like to diversify over time. So they'll say, I'm going to take 5 years to invest this because I don't want to invest in just what's hot right now. I want to diversify over time, as well as vertical. So there are all different kinds of things in modeling that you can get into that really are very much unique in your own fingerprint.
Can you go to the different kinds of angel investors slide?
There it is.
Back. Yeah. So these are not all investing at the same stages. Seattle Angel Conference is very, very, very early. Almost every other one is later. So then Sea Change Fund, and I don't see Grubstakes up there.
Grubstakes is here.
Grubstakes are the sort of the next two. Swan is not up there. They're sort of in that much. Then there's a bunch of them that are thesis oriented. We used to have a biomedical one called Wings that is closed, but E8 is the clean tech one. And then we have Puget Sound Venture Club and Alliance of Angels and Kretsu that are sort of later on. And so you can pick one of those and figure out which one of those meets your
right. So you might say,
thesis.
I want to do some that are really early stage, and I want to do some that are a little bit further out, right? And so this is all the fun of modeling your portfolio and figuring things out, and talking to other investors, and really just engaging and learning as you go. And the idea is that starting out slow and deliberate in a learning process and truly treating yourself like a beginner is a great way not to make big mistakes when the stakes are high. So going slow. Some people have said, great, do Seattle Angel Conference and really look at companies for a full year before you make any big investments. And there's something to be said for that. Yeah.
So you talk about the 25% average return or something like this.
IRR, yeah.
As I understand, like in VC funds, there is average return, but it's concentrated among few top venture firms. Is that similar phenomenon about in angel investing? It's John capturing all this 25% and everybody gets zero?
Right. So the IRR of 25% is over a whole portfolio of your investment,
Also
where again
over.
only the same power law applies.
Right. I'm thinking about distribution between angel investors. Is it the phenomenon like with VC funds that some funds have very high returns and other funds?
Oh yeah, absolutely, because some invest in Uber at the very beginning, right? And a lot of funds never are able to return more than 1x. A very successful fund in a very limited number of funds are able to return 3x the amount of investment.
The data from Rob Wolfbank, which is the stuff that she's been quoting, shows that many organized angel groups are achieving 20 to 25%. So this is
Blended
this is distributed over many angel groups.
Yeah.
There are some angel groups which are less disciplined than others and have dramatically different results.
Right, and so that's part of getting to the contact sport part, is getting to know those different groups. And going through Seattle Angel Conference, I think, gives you a really nice reference point for being able to understand, having slowed down and really done it to the sort of nth degree. Then you'll be able to see, like, oh wow, they make decisions pretty darn quick here, and I don't see the same due diligence that I really would want to do. So learning where you feel comfortable and who you want to co-invest with and who you lean on and all of that. Yeah.
So I have two questions. The first is because the investment decision is more kind of based on voting, but I don't imagine everybody, all the investors kind of in the group can be involved in the due diligence kind of process. So how would you share, or who is really in charge of the research and doing the due
Right.
diligence, and be able to kind of share it? Because based on what you guys are describing, a lot of it can be just this intuition, like, okay, this something is not right. Like, you can't really put a finger on something.
Right.
Like, how do you share something like
Right.
this and make sure that kind of gets
It's a
across
great
from
question, because I find that due diligence is one of the things that you really get the opportunity to learn in SAC. So doing the 4-week process, let's say we have 40 investors in 6 companies, we divide up into teams. And each investor is expected to participate in due diligence for a single company. During that 4-week process, we're still meeting on a weekly basis to share what we're learning as we go. So I may be on one due diligence team, but I'm learning what all those teams are learning. There's a due diligence lead on every team, and that's really important. I don't know, it kind of goes back to being in business school where you have like a team project and one person's sort of like pulling everything together. That's also the most effective way to be efficient with connecting with the founders for information requests and things like that. So that person steps up to lead that group, but every investor is in a due diligence group. And some are able to participate more fully than others, but everyone is accountable for participating and creating a report for the other investors. And so like we divided up, I did a competitive market landscape. Someone else looked at the financials. But I felt like I got to know the whole report, but I sort of had my own part of it that I was authoring, if that makes sense.
Yeah. I have another question.
Yeah.
It seems that the Seattle Angel Conference 17 is the immediate one, but then there's going to be following sessions as well. So is it that for each session, the group of investor can be different, right?
Absolutely.
So as long as they're all the accredited kind of investor that you were talking about, right?
Yes.
So, and again, because of the fact that the eventual investment is based on kind of this voting kind of process on selecting and subsetting down to a certain smaller group of startups, is there any kind of consistency in terms of, because based on the group that's kind of involved in each of the conferences, the background,
Yes.
the tendency or sort of the knowledge can be all very different, right? So the outcome can be also pretty different. So like,
We find that as groups,
Can you repeat the question? I couldn't hear.
Oh yeah, so the question is that with the investor groups changing every round, we do 2 rounds a year, how can you sort of have confidence coming into the investor group that that's going to have enough well-roundedness to it and effectiveness to it to get through and be the right result? So we're now in round 16, and John will correct me if I'm saying this wrong, but in general, those groups have been very consistent at picking the right 6 finalists.
So in general, I would say
And so that much we know.
4 out of 6 of the finalists are typically investable. I would say only once has there been sort of a shortage of investability in the startups. And I think that was probably more market related than the investor team related. The real question is, if we get 50 companies and we have no doctors in the room, then the probability of the med tech companies actually getting into the finalists goes down significantly. So the kind of company that gets invested in, because we have a wide range apply, that shifts dramatically based on who's in the room. But the quality of the companies doesn't seem to.
Right. But then there's the investor experience side, right? So with each new investor that I bring on, I like to have met them before I have them register into the fund. I share investor expectations and a code of conduct. And I make sure that I really believe that every person is able to participate appropriately. And we do have to manage sometimes conflicts. And but I would say that going through that process, whatever you get out of it, does teach you a lot about what it's like to be in a group investment experience. So you do learn that, whether it's through a massively positive experience or one that has a few sort of surprises in it. But John has the experience of sort of seeing these things, and over time, we've had a lot of really successful groups come through, and I'm very excited about SAC 16. And we're already talking to people for SAC 17 that, and we have some repeat people that come back again and again that I think really sort of stabilize and create a well-functioning investor group. But that is a part of the management process that you'll find John and Monica and I paid a lot of attention to.
I think the last point you made is the important one, where I don't know if you have numbers, John, around how many investors are coming back and how many
We aim
rounds
for
they typically do.
50-50, and we usually get very close to that.
Yep. Yeah, question?
Can you share statistics on returns from previous additions of size?
So we've been doing it for 8 years, and we've had 0 exits, but that's 8 years out of maybe 10, maybe more. And we have had a couple of companies close, but we haven't had any exits.
So we have 34 investments. Of those 34 investments, we have 6 that have failed. So we're at 28 that are still alive. None have had positive, no, that's not true. We have a marginal less than 1 return from one of the sidecar deals. We have 5 that have second or third rounds of funding in the multiple millions of double-digit millions valuation. So
Yeah.
which is right along that curve, maybe a little bit ahead of that curve. I think it's important to say that Seattle Angel Conference is not designed to build a portfolio. It's designed to teach you about angel investing and then going on to these other groups. So every one of those groups, yes, every one of those groups has an alumni of Seattle Angel Conference in it. And so there's different ways to engage in angel investing, and all of those are ways that you can get there. But as a place to start, the Seattle Angel Conference is a good way to understand the vocabulary and get the experience and then get introduced to these people. And some people come in once and then they're on their way, and some people come back 3-4 times and then they're on their way, and some people dip their toe in and say, yuck.
And that's fair. I mean, that's really why, the investment amount stays at a more modest level, is the opportunity to find
Sarah-
out if this is for you or not.
Sarah Imbach at her talk said that her first 4 investments were the tuition price for learning how to do angel investing. And then you work back in your head, no, she's writing $100K checks.
Yeah.
So for $5,500, you can get a taste of what she spent $400,000
Right.
to figure out.
Yeah, but she's also invested in 4 unicorn companies.
Right.
Was an early employee at LinkedIn and PayPal, and has a fabulous network for deal flow. So she's done quite well as an angel investor. And she also does a 101, which I've been to, and really effective in sharing her point of view. I would say Grubstakes is another group that I'm part of, and that actually was formed out of a group of Seattle Angel Conference investors who found that they enjoyed going through this deal flow sharing and conversation stuff together. So they created their own group, and it's expanded over time, and really is very, again, committed to working with early stage companies and sort of that extending an open invitation to meet early and talk to early stage companies, et cetera. So there's also someone who came out of a role like mine and started a micro VC fund in town, micro being relative, but Flying Fish is a really an outgrowth of someone's experience here. I definitely look forward to raising a fund. I think that, so these are preparatory experiences to take you in a lot of interesting directions. Question?
So as an investor, participant on the investor side of
Yeah.
SAC, I assume that investment becomes a purely passive asset after a short period of time?
Right, so I'm the one really keeping in touch with the company, and maybe I'll negotiate a board seat or a board observer seat or something like that. You really don't have an obligation other than you'll pick up your K-1 every year as you file your taxes.
And do you have to be accredited to be an investor participant?
Yes, you do. And you'll be, as you go through the registration process, it does ask you to self-certify that you are an accredited investor. So I showed you here what those guidelines are, but that's also available elsewhere. Yeah, question? Or just hand raise? You're just stretching your arms. Okay, I'll let you guys get going. It's almost 11:15, but please, we'll stick around and answer questions, and would be happy to share more. And if you really are interested in coming next Tuesday, hanging out with us and seeing what the investor group is like, and thinking this might be for you, feel free to sort of let us know. We're really looking forward to having people, again, we love to have 50% participation from newer investors, and this is all about getting an on-ramp. So thank you for coming. Hi.
Nice to meet you. I'm Sophia.
Sophia. Cynthia, it's good to meet you.
I found out about this because I'm subscribed to all the Microsoft research talks.
Oh,
so I
okay.
found that.
Yes.
I just wanted to teach for myself. I work on the HoloLens, which is the Microsoft augmented reality headset.
Yes.
And my team is really interesting. So we're serving an incubation strategy team
Yeah.
where instead of building the apps, we're helping Microsoft develop its own technology and also implement it.